Welcome to the NFO review series. In this video, I'm going to be reviewing the ICICI Quant Fund. Let's start by understanding how quant funds work. A quant fund is a rule-based fund, and essentially what happens in a quant fund is that the portfolio is built based on a model which combines a range of metrics, assigns a weight to them, and based on that the stocks are chosen. The human intervention in a quant fund is extremely limited. Now, essentially, quant funds are really data driven. They use different factors, they identify trends, and they assign weights to build a model which has a high probability to basically beat the index on the upside and limit the downside as well. The calls by the fund manager are really limited to setting the rules, putting up the weights to check if the model is working on a yearly basis. Certainly, there is absolutely no active management based on market movements, or, for example, if the fund manager has some high conviction bets, clearly these bets cannot be taken unless they come as part of the model. Quant funds come under the thematic category. And as far as the risk is concerned, they are high risk funds as well. Now, quant fund can be categorized as at two types. One is the index based funds, and the other is the diversified funds. So, what are the advantages of quant funds? Well, certainly it's lower cost as compared to investing into an actively managed fund. Another advantage of the quant fund is that they're able to analyze a large amount of data on a real time basis, which means that they can also implement investment decisions faster. Due to their neutral bias, their ability to basically be more effective in implementing trading strategies is better, or in case of where there are very narrow price differentials, quant funds would work better. Of course, the other big thing is that you don't have to worry about the fund manager quitting, or errors being done in fund management and stuff like that. But, all of this does not guarantee better performance. Remember that quant funds basically are built on models which is based on past performance, and past is always not a great indicator of the future. In case of quant funds, there is some rebalancing that is done on a regular basis. But if this rebalancing happens so very often, it's certainly going to have an impact on the costs of the fund and hence would eat into the returns. The ICICI Quant Fund basically is going to be investing in stocks from the S&P BSE 200 index. Now, essentially, what they're going to do is that based on the parameters that they choose, they're going to eliminate stocks, and then they're going to shortlist companies based on various macro, fundamental, and technical factors. Give a weightage to each one of these particular parameters, and based on that, they're going to come out with a portfolio of 30 to 60 stocks using the composite score and the market cap. Some of the quantitative parameters that they're going to use is the market cap to GDP ratio, price to earnings, price to book, dividend yield, return on equity, etc. This is an indicative list, and they're really not clearly specified what are the parameters or the model that is being chosen. There's going to be rebalancing that's going to be done on a periodic basis. So there's going to be an annual review on the parameters of the model. And it could also be ad hoc based on some adverse news or some corporate action that might come. The quant category is quite nascent in India. There are only a couple of funds, and honestly, their performance has not been so great as compared to the actively managed funds. I think, this fund is for those people who believe that they want to be in a quantitative strategy rather than active fund management. And for those who want to do so, I think they can try out the fund with a small investment, limited to less than 5% of your overall portfolio. You'll have to wait for a while to see if the strategy is really working out, what sort of model has been implemented, what are the costs. Certainly, as far as costs are concerned, we are expecting the expense ratio to be somewhere between 0.75 to 1%, which means it's lesser than an actively managed fund, but it's certainly much higher compared to an index or an ETF. My take, you can try out the fund if you want to invest in a quantitative strategy, but limit your investment to a small amount and wait and watch how the fund works out. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye bye.